Good evening, everyone. Time for another silver update. This is the daily chart of gold provided by netdania.com. Now, this has a couple of trend lines drawn in here. The first one, the lower one, is based on the first three touch points that were at the beginning of this rise from the reflation of beginning in 2009. And the second one is drawn from mid-2010. You can see they parallel each other. So we may correct back down to this lower one, but my guess is we're probably going to maintain this upper one. You can see there's quite a bit of consistency here. Just this brief dip down here, and then we're on the way back up. The MACD is compressing as well in sort of a flag formation. You can see that we're moving to the upside now on that. We are at -10, but I'm sorry, -4, but we're looking for a crossover to the positive side. That really hasn't occurred since the rally that we had back. We had a fake out here, but the little rally that we had in the summer of last year, and then you have to go all the way back to the beginning of 2012. As Andy Hoffman has pointed out recently, I believe he said that 9 out of 12 of the last years of the bull market in gold have been marked by a bottom in the January time frame. So the seasonals are also very well lined up, and when we start to look at the stories that we're going to cover on gold, specifically the German Bundesbank gold story, we're going to see why there's a very good reason to believe that we're going to see a bottom as well in January of this year. Now, I wanted to start off by reading the latest GAAP or LEAP 2020 report. The reason why I like to read this report is because this report is a Eurocentric report. It is not based out of the US, and it has a completely different perspective. And as you'll see, they believe that the United States is the weakest link in this whole economic chain. So let's read some of this, and then we're going to go to the analysis of the German gold story. Until now, the course of the crisis has been accurately described according to the 5 phases identified by our team from May 2006 completed in February 2009 release: acceleration, impact, decanting, and global geopolitical dislocation. The last 2 stages developing simultaneously. In the last issues, and in particular the GAAP number 70, December 2012, we commented extensively on the ongoing process of the last 2 phases, a decantation from which the world after painfully emerges on the rubble of world geopolitical dislocation. But we had underestimated the decanting's period's duration, which we have gone through for more than 4 years, a period during which all the crisis players have worked to a common goal: to gain time. The United States, whilst making every effort to prevent the appearance of alternative solutions to the dollar, in spite of catastrophic situation of all its systemic fundamentals, to prevent its creditors from abandoning it, discrediting other currencies, including the yen from now on, tenacity against the attempts to disconnect oil from the dollar, etc. The rest of the world in setting up skillful strategies consisting of maintaining its assistance towards the United States to avoid a sudden collapse from which it would be the first to suffer, and at the same time constructing alternative and decoupling solutions. In other words, looking for an exit. At the end of this long period of the system's apparent anesthesia, we consider it necessary to add a 6th phase to our description of the crisis, the last impact phase, which will occur in 2013. The United States certainly believed that the rest of the world would have an interest in keeping its economy on artificial respiratory assistance ad infinitum, but it is likely that they don't believe it anymore today. As regards the rest of the world, the final chapters of the U.S. crisis, major political crisis, decisional paralysis, near miss of the fiscal cliff, perspective of a payment default in March, and always the incapacity to implement the least structural solution. And that is true in spades. We've seen that. The only solution they were able to find in the last negotiation was to raise the payroll tax on everyone by 2%. So a abysmal failure by U.S. leaders. Convinced it of the imminence of a collapse, and all the players are on the lookout for the least sign of a swing to extricate themselves, conscious that by doing so they will precipitate the final collapse. Our team considers that in the context of the extreme tensions, both domestic, political, and world financial tensions induced by the next raising of the U.S. debt ceiling in March 2013, the signs will not be lacking to cause the disappearance of U.S. Treasury bonds' last purchasers, a disappearance which the Fed will no longer be able to compensate for, resulting in an increase in interest rates which will propel American indebtedness to astronomical levels, leaving no hope of ever being repaid to creditors who will prefer to throw in the towel and let the dollar collapse. A collapse of the dollar which will de facto correspond to the first genuine solution, painfully, certainly, but real for U.S. indebtedness. It's for this reason also that our team anticipates that 2013, the first year of the world afterwards, will see a setting up of this purifying of U.S. and world accounts. All the players are tending towards this step, whose consequences are very difficult to predict, but which is also an unavoidable solution to the crisis, taking into account the United States' structural incapacity to set up genuine debt reduction strategies. But in order to take the measure of the causes and consequences of this last impact phase, let's consider the reasons for which the system lasted for so long. Our team will then analyze the reasons for which the shock will take place in 2013 and afterwards, saving time when the world rejoices at the U.S. status quo. Since 2009 and the temporary measures to save the global economy, the world has been waiting for the famous double dip, the relapse, as the situation continues to worsen day by day for the United States. Breathtakingly high national debt, mass unemployment and poverty, political paralysis, loss of influence, etc. However, this relapse still hasn't arrived. Admittedly, the exceptional measures of assistance to the economy, lowest interest rates, public expenditure, debt repurchase, etc., are still in force, but against all expectations and contrary to any objective and rational judgment, the markets still seem to have confidence in the United States. Actually, the system isn't based on confidence anymore, but on calculating the best moment to extricate themselves and the means of hanging on until then. The time has passed when China challenged the United States to implement a second round of quantitative easing. The world seems to have adapted itself to the fact that this country is still growing its debt and is inescapably turning towards a payment default, provided that it's still standing and doesn't make too many waves again. Why don't the other countries press the United States to reduce its deficit, but on the contrary are delighted to when agreement on the fiscal cliff keeps the status quo? However, nobody is fooled. The situation cannot last indefinitely, and the world's economy's main problem is really the United States and its dollar. So, I don't 100% agree with Leap 2020's analysis, but I definitely agree with them more than a lot of the U.S.-centric positions. Now, I wanted to get over to this gold story because this is very important regarding the United States and its gold reserves, especially its gold reserves that are stored for other countries. This story is from Zero Hedge, and this is talking about the fact that it will take the Fed 7 years to deliver the 300 tons of German gold. Now, we know that there's roughly 3,000 or so tons that the Germans are requesting, but when we get down to the bottom here, but the biggest news of the day comes from the official BUBA announcement that in its official capacity as a prudent central bank, it, as first of many, is looking to repatriate some 300 tons of gold from the New York Fed. That, however, is not today's news. That was Monday's news. What is news is that courtesy of the supplied calendar of events in the BUBA statement, it will take the Fed some 7 years to procure Germany's 300 tons of gold. This is the same Fed that, in its own words, holds some 216 million troy ounces of gold, or some 6,700 tons in its vault 80 feet below ground level. Putting the above in perspective, the amount of gold that Germany will have to wait 7 years for is shown in red. The amount of gold the Fed supposedly holds is shown in yellow with a shade of tungsten. Why it will take the Fed 7 years to part with an amount of gold that is less than 5% of its total holdings is anyone's guess, unless, of course, the bulk of the gold in the column on the right has been rehypothecated numerous times to serve as collateral for countless counterparties, and is no longer clear just who owes what to anyone. So there's the supposed reserves by the Fed, and on the left here is the supposed gold that they hold for Germany. Now, we're talking about 300 tons of gold. Now, before we do the math on that, let's take a look at the latest gold infographic, and this is from Demonocracy, and you can see here they start off with the grams of gold, and up to an ounce of gold. You've got a $100 bill and a pen. You can see how small it is. Then we've got 1 kilogram of gold. It's really not much more than a pocket knife. We've got a 400 ounce gold bar, and that's a lot less space than a stack of $100 bills that equals the same. And below here we've got 1 ton of gold. So you can see here 1 ton of gold. Here's your pen. This is not a lot of space. So we're talking 300 times that, shown in the back of a truck here. Here's about 2 tons. So that would be about 150 of those trucks. And then the next one is 10 tons versus 100 tons of gold. So Germany is talking about repatriating from the United States roughly 3 times this stack. That wouldn't seem to be a very large logistical problem. And the last one is going to be the long haul truck, and you can see that holds about 25 tons. So it would take about 15 of these trucks or so to get that gold back to Germany. And of course that's going to take 7 years for about 15 of those trucks to get there. So, but let's do the math on this and get an idea of how much money we're talking about. So I'm going to do that on the calculator. Now we know that give or take, I'm not sure how the troy ounce and the conversion works, but we'll just use the standard figure of 32 ounces per ton. So you got about 32 ounces of gold in each ton. We'll multiply that times the 300 tons, and then we'll go ahead and multiply that times the $1,700 an ounce for gold. So that's going to give us roughly a figure of about 16 billion. You can give or take. My math may be wrong, but somewhere between 15 and 20 billion dollars is going to be the dollar value of the gold that Germany is talking about repatriating back to Germany from the United States. So when we think about that, we're talking only about, let's just say, $20 billion. So it's going to take the United States the next 7 years to deliver back to Germany about $17 billion worth of gold. In other words, about we'll say $3 to $4 billion a year is all they can afford to pay up. So the question I would ask, and I would expect anybody who's rational to ask, for example, let's say you had your gold or your silver stored at the Perth Mint or one of these other depositories, and let's say you had this in an allocated account, so you knew it was allocated, it was there, and you called them up and said, hey, I'd actually like to take delivery in my home country. When can you get my gold sent back to me? And the Perth Mint or one of these other replies to you and says, well, it's going to take us about 7 years to get that gold back to you. And we're going to do that over the course of those 7 years, send a little bit each year. And of course, your response and my response would be, no, that's not acceptable. I'm not willing to risk what can happen in those 7 years. I'd really like to get my gold right now. So is there anything else we could do? And they may say, well, we can go ahead and pay you cash. We can cash out at the current price and pay you cash for your gold, and then you can take that cash in lieu of the gold. And so the question is, this is a big question that comes up, if it's going to take 7 years for Germany to repatriate their gold from America, and it's only $17 billion, why doesn't Germany just simply ask the Fed to write them a check for that 17 or 18 billion dollars, and then they can just go out and buy that on the free market, take delivery, and get those 15 trucks or 7 jet planes worth, or whatever it would take, a very small logistical amount of work to be done to get that gold delivered. That's the big question, why? And I think you know the answer to that question, because any attempt to take delivery of that amount of gold, and we're only talking about $17 billion worth of gold. Now you have to remember the Federal Reserve is buying up $85 billion a month of debt, and they're unable to deliver $17 billion worth of gold. It takes them a period of 7 years. So I think when you look at it that way, it becomes very obvious that we're approaching endgame with this, with these gold games. The sovereign nations of the world are getting fed up with the games that the Federal Reserve has been playing, and they're starting to look for an exit. As Leap 2020 has pointed out, it's not a matter of being allied with the Federal Reserve and planning to agree with their endgame, but it's rather a strategy of trying to find an exit. And of course, we know how these things end. When there's a scramble, when there's a rush for the door, when the music stops and everybody tries to find a chair, then it's going to be who has the physical gold. So you tell me. It seems to me that it would be highly in the interest of the Bundesbank to simply request the Federal Reserve wire them their dollars, and they could just go ahead and take delivery of their gold on the LBMA and have that done. So I would wonder why the German people wouldn't demand that, And who is behind this request? Of course, the spin we're getting is that it's at the request of the Bundesbank that it takes 7 years, but it may be the result of some type of negotiation with the Federal Reserve, who possibly has rehypothecated the gold. We don't know how many times, but apparently is unable to deliver even 300 tons of gold in a timely manner. And that does not bode well for the future of the United States gold reserve, the Federal Reserve, and the situation that we're heading into very, very quickly. So it's in everyone's interest to get physical delivery as soon as they can, because it appears that the prisoner's dilemma is starting to break down. There are cracks in this global game, this global gold game, and we're going to see some rapid moves a lot faster than we've seen in the past. You have to remember, as Tyler Durden has pointed out, it was only last fall when Germany announced that they were just going to very slowly repatriate a very, very small portion, and we can see just 3 months later they're moving this timeline up. Very, very similar to what we see in China. Every time China comes and reports about the amount of physical gold that it's imported, it's 2 to 3 to 4 times the amount they said they were importing. So it looks like the rush is on. Everybody is going to be panicking into physical gold before the next system is rolled out. And it looks like the dollar is the one that's going to be on the chopping block. And we'll talk to you next time.